Why don't I just buy a mobile home park myself? The solo path, it's the hardest, it's the slowest, and it's the riskiest way to build wealth in real estate. That's the difference between owning a job and owning an investment. We've inherited millions of dollars in equity because I can piggyback and leverage off their reputation. If I knew back then, the game would have changed for me for sure.
What should anyone look for at a fund?
Today's show, I want to eliminate this false reality that the only way to passively invest, if you don't want to be the one to do it on your own, is invest in the stock market. I know that growing up, that's how I thought, that if I just wanted to invest my money and not really be involved in the day-to-day stuff, right? Investors think that way. But we're going to nix that false reality in today's show.
Joe, we're Buying America, and today we will be discussing about why should I go into a fund if I understand and I'm even in love with a specific asset class where I can even go and find these deals by my own, operate them, learn more about it. Who knows? Even I can even scale that up. So why going into a fund?
Very good question. And I'll tell you, so I think part of the answer that you're going to get from me is lessons that I learned as an investor. And honestly, here's probably the question that I've gotten more consistently over the past year than any other time. And I've been investing for 30 years. And it's like, Joe, why don't I just buy a mobile home park myself? Like, why give up control? Why put money into somebody else's fund? And I get it. You know, every investor starts out wanting to do it alone, including me. You want the control. You want the whole return. You don't want to split anything with anybody, right? But here's what I learned. Capital, closing deals, watching hundreds of investors try to go it alone in this market. The solo path, it's the hardest, it's the slowest, and it's the riskiest way to build wealth in real estate right now. I mean, maybe, when I was first starting off 30 years ago, the path was, much less resistant. But I think in today's day and age, with there being so much competition, with the limited amount of supply, and then it just feels like there's so much more data to analyze. It wasn't, Diego, when I first started off, if you made an error, the entry level was so low, so you were there was sort of like a built internal forgiveness, right? Not something that was intentionally done, but I think because there's so much more competition, the spreads are so much thinner, that there really isn't room for error, and to try and assemble the whole thing on your own, from acquisition to finding the deals to analyzing the deals, it becomes so much more tougher today. So let's start off with that. I can get into the reasons for sure.
Okay, I mean, I understand, and sometimes probably the first argument for a lot of people would be, well, that's passive, and people do, most of the people like passive. If you read the most famous investment books, they all even follow down to the idea just buy low cost indexes and wait for 30 years. But probably we are talking more to the people that feel entrepreneurial enough to actually go and execute stuff. And let's say, Joe, but you're talking about a fund, but what if I want to be related? Because I find this a lot. A lot of people want to be involved. Probably it comes down from a fear. But I would like to connect this idea of, necessarily being involved doesn't mean you need to operate. And then what does the fund give me that can make me feel involved? You know what I mean? Is that making sense? Because some people have this idea where it's, black or white, where, oh, if I give the money into a fund, I want to know what it's being done. And they're not, familiar with the reporting that usually comes with a fund. So I think there's a line in the middle that some investors still need to discover, because, for example, in our funds, we do invite people to get involved, to understand, to actually visit the parts, to understand the thesis, to ask questions. So how those funds actually respond to this need from some investors of having the feeling of being involved?
Well, okay, I think we need to maybe backtrack a little, because what'll lead to answering that question is maybe if we outlined several points on the benefits, right, of partaking in a fund and collaborating, as many investors are doing and have been doing with us in our existing fund, right? I would say, yeah, for as much as you want to participate, the reality is, let's say reason number one, solo investing, you lose a lot of ground as far as deal access, okay? The best mobile home parks, the best real estate deals today, they're not sitting on, people look at LoopNet online.
Rexy.
Yeah, exactly. And with a for sale sign, they're moving through broker relationships, right? Off-market networks, operators who already have a track record. So and that gives us tremendous advantage. Think about this. A first-time individual who's buying and they have $200,000 or $500,000 to deploy, and they're competing against a fund, our fund, where we can write a check for $2 million on a deal, $5 million, $10 million, and close in 21 days, with hard money down. It's pretty difficult, right? When you start to look at it from that spectrum, it's pretty difficult for that solo investor to compete with something like our fund, or there's funds that are much more substantial than ours, which makes it even difficult for us to compete when we're talking about the enormous deals. But at least we still have access to very good deals. And the broker relationship that I'm talking about comes from being able to close on, we've closed on almost 10 parks, and millions of dollars worth of real estate. That lends to credibility. And if you're that solo investor and you want to get into this and you want to get into the game, well, it's only logical that the relationship that you're trying to establish with that broker, it's just going to be a tougher mountain to climb, right? So, okay, that's a pretty substantial point, I would say. Let's talk about now the diversification. If you're an individual investor and you save up enough money to buy one mobile home park, okay, well, now you have 100% of your real estate net worth in one asset, one location, one market, one set of tenants. One bad storm. Let's think about that, right? One bad storm, one major employer that might be leaving that niche market, one unexpected CapEx issue. That's not a diversified. That's not a diversified portfolio, right? That's just a bet. You're gambling on one thing. Whereas if you were able to participate in a fund, it's divested over many parks, over different states. When investors pool capital into a fund, the reality is that same $200,000, if you were trying to do it on your own, that same $200,000 now, it touches pieces of 5, 10, 15 different properties across different states, different tenant bases. That's the difference between, placing a bet and then having a portfolio.
Okay, I mean, and we can follow that line because what you're talking pretty much is about scale. I would like to round up the same things you said, which is some investors know it, some don't, but retail investors need to, digest the idea that they're usually not getting any of the assets they can look at the best price. Because we can discuss over, I mean, across many asset classes, crypto, stocks, even indexes, and usually the retail investor is the last one to see the price of an asset and to know about a trend. So with that said, you're also, when you talk about diversification, we can also get into how a fund lets you operate in a bigger scale. So your operations cost per park are every time smaller and smaller, which leads us to better margins. So that's an idea. But tell me, how would you respond? Because, okay, I'm an investor. I also understand that I'm not reaching the asset at the same price you're reaching it. But Joe, I still want to feel like I understand, like I'm part of it, or that I at least can, know what it's being done with my money. So what does a fund provide to an investor in terms of, communications, reporting? Because we've talked to many people that believe that, okay, so you get involved in a 7-year fund, so you give us your money and we'll talk back to you in 7 years.
Sure. And I think, I think there's this, misconception that if you're not going at it solo, then you don't have access to the data, and you really don't know what's going on. In reality, that's a fallacy, because one of the fund's responsibilities is to provide reporting, and in the reporting it's okay, guys, here's a summation of, how these specific assets are doing. Here's what our goals, objectives are. Here's what we're doing to stabilize a park. So there's a lot of data that comes. I mean, look, the truth is that there's investors that want to be as passive as they possibly can get. You're asking the question on those that maybe do want to be passive at the same time. They want to have a little bit more engagement, and that's perfectly fine. Just because you participate in a fund doesn't mean that you're not entitled to ask for reporting, which is given. You're not entitled to ask for questions. But let's be honest. To what extent do you want to be involved when you're going at it solo, right? And I hate to revert back to this, but I have to, because I think that these are pertinent points. Let's be honest. You own a mobile home park and you're doing it solo. You're the one who has to look at the day-to-day tenant screening, right? The rent collections, the infrastructure repairs, the code compliance, evictions. It's all part and parcel of it. Water, sewer issues, park management staffing. Like, most solo investors either become full-time operators by accident, I've seen that, or they hire management and watch their margins get eaten alive because they don't have the scale to negotiate good rates or build real systems. In a fund, you get a team that's already built the operating playbook, the acquisitions, the underwriting, the asset management, the investor reporting, all running at a scale where those costs are spread across many properties and not sitting on top of one. That's the difference between owning a job and owning an investment. So, in a round, I don't want to make it seem like we're circumventing that question, but at the same time, it's really important to distinguish for those that want to be able to fully understand what it means to go solo and what it means to be part of a fund. If you go at it solo, and I've experienced this, it's a job. You're creating a job, and it's not necessarily owning an investment. We got to make that distinction very clear. And just because you transition from owning a job into owning an investment because you're part of a fund, again, I'll reiterate this, does not mean that you're not entitled to reporting or asking questions, and or if you want to understand. Very few investors, I can tell you, they say this from the onset, but then the reality is when it comes down to it, they could care less. They're not as engaged as you think. They may want to know how you're stabilizing. They may want to know what your management strategy is, what the strategy of the fund is. But beyond that, they don't want to be the operators. They think they do. And I think I've seen a lot of investors through my years of investing who thought they wanted to be the operator, they wanted to be like hands-on, and then ultimately realized, God, I don't want to do this. The problem with that, though, is they're foregoing the investment, the viability of how good it is to invest, and the significant impacts of like building wealth through real estate. Because then all of a sudden their mentality gets skewed and they get like turned off by having to deal with the operator mentality and they get exhausted. This, unfortunately, for like, let's say the mom and pop operators, but fortunately for like funds like us, is those mom and pop operators get to a point where they're exhausted. They realize what they did was they created a job for themselves. And those solo investors, they get exhausted. Same thing. They think this is what they want, and then they ultimately realize it consumes my life, my every moment, right? And on the flip side, I guess, fortunately for us, is that's where we can come in because we have that infrastructure in place. We can alleviate them of those headaches. I tell you, it's in a weird way, in talking to some of these mom and pop operators, you come to find out that they forgot why they were even doing this to begin with. They thought they were investing, they thought they were building wealth, and after like so many years of doing it, they're like, I don't even know why I got into this to begin with. They're just so tired. But that opens up the opportunity for funds like us to come in with good solid infrastructure and acquire. So
I mean, I think when we discuss that also, because you said something very important, people tend to believe operating their own investments can be the best way to be building wealth, or they can believe that, oh no, a fund is gonna, is gonna eat my margins with fees and commissions and other stuff. So I'd rather operate and get better returns, which is I would say a misconception, because it would be very interesting to compare returns on well-established funds on a specific asset class against individual operators that sometimes are learning through mistakes. But I would like you to address that, Joe. Probably you're saying that because you have a fund, but isn't a fund gonna eat me or eat my money through commissions and fees and other stuff?
Look, and that's a very good question. And I think, the best way for me to answer that is I have no problem paying for very good service. If I'm going to pay an attorney, if I'm going to pay an engineer, if I'm going to pay a doctor, if it makes my life easier, more efficient, healthier, who wouldn't feel that someone is deserving of a fee and paying that if it frees up your time, right? And if it enhances your wealth. I think the misconception is when you're paying and then you don't get what you pay and you feel frustrated and you're like, God, it's not worth paying those fees. But look, at the end of the day, if I'm going to pay someone, and this is just an example to conceptually understand what I'm trying to get across, is if someone said to you, hey, pay me $10,000, I'm going to alleviate and remove all the headaches, the frustrations, the day-to-day stuff, and I'm going to give you a, let's say, 10% return on your money. Heck, I don't care if it costs me $15,000, $20,000. At the end of the day, if it means that I get a healthy return and probably a better return than what I would have gotten on my own, I'll gladly pay a fee all day long. Does that make sense?
I mean, yeah, it makes sense, but I think I would like to also close that idea that, again, funds sometimes do their projections, or, for example, our funds also project the IRR after those fees, are considered. So people shouldn't be stopped by saying, "Oh, probably I'm reading something that is misleading because that's gonna be eaten by fees." You know what I mean?
Well, and the reality is too, right? So look, this is a perfect example. You and I, we assessed the viability of several parks. So there was this one owner, and he owns, I think it's either 4 or 5 parks, one or the other, but it's several parks. The reality is the negotiations that are happening with these parks right now are happening, and the acquisition could be millions below what that park owner could possibly get if that was made available to the public, right? And if he funneled that through a broker relation. Okay, I would pay, and I'm sure you would agree with this, I would gladly pay a fee to the fund that I'm involved with, to the operator of a fund, knowing that we've inherited millions of dollars in equity, because I can piggyback and leverage off their reputation, their ability to scale. So like maybe it costs a minimal amount on the front end of whatever a fee is, but then on the back end, now you open up the window to millions of dollars in equity, because you were able to negotiate that and get that from the onset. If you were a solopreneur or a solo investor, and you were buying that, maybe you're paying $1 million, maybe you're paying $2 million, maybe you're paying $3 million more on a larger acquisition like that, because it's just you doing it, and you don't get to participate off of the leverage of a fund. So I think what people need to not get caught up in, some of the smaller things, look at the viability of the fund. What are they doing? How are they stabilizing? When they're stabilizing, we purchased parks for $2 million that after stabilization were worth $5 million, right? So is that worth paying a fee? Is that stabilization? Is that value add? Is that all stuff that you can do on your own? You'll come to realize that it's not something that you can do on your own, and then ultimately you're going to have to hire others to do that. So whether you hire them or just participate in a fund and pay a fee, I mean, it's you're and you end up getting to the same conclusion.
Yeah, and okay, so let's say you and the people who is listening are convinced now that a fund is a good way to approach an asset class, let's say, to have exposition to a specific asset class. What should anyone look for at a fund? Because the offerings of funds in any asset class is massive, even though we have some big references of funds that we all know. Let's say I like the idea of a fund. I'm gonna say whatever. I like the idea of mini storage, and I see that there's 15 different funds available for me that I'm an accredited investor in the US. How do I disseminate those options?
So there are several things to look at. One is like, what's the viability of that fund? Is this someone that has experience? Have they stabilized before? whether it's investing in self-storage or like in mobile home parks that we're doing. Does the operator have extensive experience? You know, can they show the viability of it, or is it? I mean, and unfortunately, in today's day and age, everyone wants to kind of jump on the bandwagon and then invest in real estate. You know, because you see it everywhere you turn. I know people that have tried to put syndications together to, you know, try and create funds, and they've never done it before. And I think the history, the history of the operator means a lot. The viability. So I would find out, well, what's the experience? How many parks have they stabilized? What acquisition fee do they charge? What asset management fee do they charge? What property management fee do they charge? What is the fund's strategy? Is there an exit strategy? There's a lot of funds, and I would be cautious of this. There's a lot of funds that get investors involved, and then once they refinance, they pay the investors, and the investor out of the deal. And it's amazing how many people don't ask that question. And I think we take great pride, right, in the fun that we have and all the deals that we've done. We make it clear to investors that, hey, you get to participate in the upswing. You get to participate in the long-term viability and growth of this asset. So all this hard work in stabilizing these assets, you're here. You're here for all the wins. It isn't just, oh, here's your healthy return, and then once we stabilize and double the value, we're gonna pay, and then you're out of the deal. You can get paid at one point or another. It's possible to have your principal completely paid back, and then still 100% equity position in the fund. And here's an advantage. Think about that. And if you get to remain in the deal as an investor, the equity continues. When you refinance, again, if you're doing this solo, you're going to the bank. The bank's going to lend you money based on your relationship, based on your credibility, based on your seasoning. But if you're collaborating and piggybacking off of the operator in a fund, and like this is the way our fund works, we go to the bank. We go and get the loans. At some point or another, when we refinance and the investor gets their principal, they still get to remain part of the fund. They have a piece of all these deals, but that debt is not necessarily their responsibility. They're not the ones that are signing off on that debt. And it's funny because even with very sophisticated and savvy investors that I've had that conversation with, they're amazed at that point. They're like, wait a sec, Joe. So you're telling me that when you go to refinance, you're the one, you as operators are going to like guarantee the loan. I don't have to sign off on that, but I get to remain part of the deal. Like even once I get principal back, I get to like stay in the deal. And then if like 10 years from now, 15 years from now, 20 years from now, this thing doubles or triples, let's say hypothetically, right? I still get to benefit off of that. Yep. And when our answer is yes, man, they really start to understand the power of a fund, the power of collaboration. And, you know, these, in my initial beginning investing career, I was oblivious. I was oblivious to like the power of that. I would have gladly said, hey, I felt like I climbed a mountain to get to my like first million. Like, okay, now I gotta like, you know, try and like double that and then triple that and get to like this, you know, 10x that everyone's starting to do. But if I knew back then that I would have had the ability to piggyback an operator who would have then been able to get those loans and still participate in those deals, I mean, the game would have changed for me, for sure.
Joe, so if people would like to contact you and see how they can participate in one of our funds, how can they reach out?
That's a good question. Mario, how can they reach out? We have to do some editing.
I mean,
I don't know. What do we say there?
Some information in the description then, and so anyone that wants to listen more about our strategy and has, some money on the sidelines that would like to be deployed, we're ready to chat with them and share what we're doing.
So, Diego, why don't I ask you that question?
Yeah.
Okay.
Well, right, they can send us a message to any of our social media. We're in all across all platforms as Buying America. If you guys send us a message, we can happily respond and reach out through the best channel available, email or phone. So we will also work on having direct links to contact us sooner for anyone that wants to reach out.
And there's, for people in the U.S., we deal with a lot of like foreign nationals who are into the American market for foreign nationals. But for Americans, we'll have a show on this, on precisely how it's done and get into a little bit more detail. But for Americans that have, or if you're a permanent resident here, and you have a 401k or you have an IRA, yes, these funds are. So you can, if you're not satisfied with the returns that you're getting in your 401k or your IRA, we can definitely consult and guide you on how you can use these retirement to participate in the fund. And the way, again, we'll have a much more detailed show on this, but there's several types of retirement accounts you can set up where the funds generated in that retirement account can continue to grow tax-free. Never ceases to amaze me, how many people are not aware of these vehicles. They're there, and we'll gladly get into more details on how that works, because there's a lot more people asking those sort of questions. So,
well, thank you, Joe. Let's continue this talk in future episodes, and thank you for everyone listening.
Thanks. Hope you enjoyed.